10:02, and thank you everyone for joining us this morning. Appreciate you being here. My name is Sean Rose. I'm the Executive Director of Gift Planning at Stony Brook University, and it's my pleasure to welcome you all here this morning. With more than 30 years of experience, the gift planning team here at Stony Brook has the privilege of helping individuals and families shape legacies they envision. Legacies that not only provide for loved ones, but also uplift the institutions and causes they care mostly about. At Stony Brook, this work has special meaning. Every gift, no matter the size, strengthens our university, fuels discovery, improves patient care, and touches lives across our campus and community. Our role as gift planners is straightforward but important. We help those who want to give more, and give more wisely. This can mean including Stony Brook in a will or a trust, designating the university the beneficiary of an account or a life insurance policy, or even establishing a life income gift, such as a charitable remainder trust or charitable gift annuity. These kinds of gifts are all about strategy and partnership. They allow donors to take care of themselves, their families, and even their tax situations, while also making a lasting impact at Stony Brook. And today's a particularly good time to be talking about charitable gift annuities. Rates are at record highs, which mean that you can secure guaranteed fixed payments for life that are locked in at the time of the gift while also advancing the mission of Stony Brook. These days, it's rare to find an option where it benefits you, but also benefits your favorite charity, such as Stony Brook. And speaking of missions, Stony Brook is in the midst of an extraordinary moment of growth and momentum. Over just the past year, we've celebrated milestones and recognitions that affirm our leadership and impact in powerful ways. In February, Stony Brook earned its highest Times Higher Education ranking in physical sciences since 2016, climbing into the top 100 worldwide at number 84. We also advanced in computer science and in business and economics, underscoring our expanding strength across multiple academic disciplines. Stony Brook Medicine was once again named one of the best hospitals in New York State by U.S. News and World Report, a reflection of the extraordinary work and dedication of our physicians, nurses, researchers, and other staff. And Forbes recently recognized Stony Brook as one of the best employers in New York, a distinction that speaks to the quality of our community and the university's commitment to those who make our mission possible every day. When you combine these achievements with the historic $500 million unrestricted gift from the Simons Foundation for endowment, the New York State matching gift for endowment, and our new president, Dr. Andrea Goldsmith, it's clear we're entering an era of remarkable momentum. Dr. Goldsmith is a globally recognized engineer, entrepreneur, and academic leader. Before coming to Stony Brook, she served as Dean of Engineering at Princeton, where she oversaw substantial growth in faculty enrollment and sponsored research. She has also founded technology companies and helped shape national science policy, bringing both vision and practical experience into turning ideas into impact. Today, she leads not only our academic enterprise, but also Stony Brook Medicine, Long Island's premier academic medical center. She chairs the board of the New York Climate Exchange and co-chairs Brookhaven Science Associates, which manages Brookhaven National Laboratory. The breadth and leadership underscores the exciting and transformative chapter Stony Brook is really now entering. And for those of us who have been able to meet her so far, she is truly dynamic and a wonderful person. As we move into the presentation, I have one disclaimer, and David might have his own, but we always have to put this. As we enter today's program, I do want to note that, well, the lights just went off. That was tremendous. I guess I sat too still for too long. I do want to note that you'll hear what you'll hear is purely informational. Neither David nor I know the specifics of your personal situation, so nothing shared today should be considered legal, tax, or financial advice. We strongly encourage you to consult with your own professional advisors when making decisions about your planning. Also, the Q&A format will be interactive. So feel free to type your questions in or raise your hand, and we'll call on you when there are natural pauses in David's presentation. There'll also be Q&A at the end. So please ask your questions as we go along. I'm sure you'll have many. And without further ado, let me introduce David Hungerford, ChFC, CLU, AIF, CPFA. David's professional journey is remarkable. After graduating college in 1972, he served our country as a lieutenant commander in the U.S. Navy, flying carrier-based aircraft. In 1978, he transitioned into financial services, where over 4 decades he has earned multiple advanced credentials from chartered life underwriter and chartered financial consultant to accredited investment fiduciary and certified plan fiduciary advisor. Along the way, David has shaped minds as an instructor at Hofstra University, led strategic planning teams at Equitable Advisors, and today serves as a partner in the Black Oak Group, a firm composed of highly credentialed retirement planning specialists. He also brings a personal connection to our region. As a longtime resident of West Islip and a member of the Nissaquah Golf Club, David understands the financial and philanthropic landscapes of our community. He's also more recently become involved with our Long Island State Veterans Home at Stony Brook, which we greatly appreciate. This morning, he'll guide us through building a family legacy through tax-efficient charitable planning, a topic that ties together financial planning, philanthropy, and impact in exactly the way we strive to do at Stony Brook. Please join me in welcoming David Hungerford.
Yep. Good morning, everybody. Thank you for your time and interest in attending the session over the next 20 to 30 minutes. That's Sean up there. Okay, the next 20 to 30 minutes, we'll be discussing 8 ways that you and your family can create a gift of surprising significance to the Stony Brook Foundation. Having been in the retirement income and estate planning business for the last 45 years, time goes by fast, I have come to appreciate the power we all have to help those entities that have made a difference in our lives. So what I'd like to do is I recently read a study about why do people donate? And I'd like just to share that with you because why do people do good? And the first one was compassion. Many families simply want to help others. And we thank you for your participation in the foundation previously. Connections. Someone always has a direct connection to a charity. For me, it was pretty simple. My wife had breast cancer, and thanks to shout out to Doctors Bear and Doctors O'Hay at Stony Brook Breast Center, she has been 10-year free of cancer. Legacy, ensuring how you will be remembered, and we all know that time is short. Community, obviously people want to improve the communities that they live in for themselves and their families. Reputation, again, public giving simply demonstrates leadership. And lastly, tax benefits. And that's the purpose of today's meeting. But again, I can assure you that tax savings, though, is a motivating factor. It is not the number one factor why people contribute money to charities. It's always because they want to do good. But we love the fact that Uncle Sam and the state of New York sometimes will help us participate in our contributions. And that's what we're going to talk about today. So let's get into it. Let's talk about what we're going to talk about here. Outright gifts of cash and property, estate or testamentary gifts, beneficiary designation gifts, charitable gift annuities, also donor advisor funds, also known as the donor advised funds, qualified charitable distributions, and of course, my favorite 2 trusts, the charitable lead trust and a charitable remainder trust. So we're going to talk about all of these in somewhat of details. Let's talk about outright gifts and cash. Now, there is a problem here in the fact that, as you see here, cash gifts are deductible up to 60% of AGI, and appreciated assets, such as a stock that you're donating that you bought for less money and it's appreciated, or real estate, is deductible up to 30% each year against your AGI. Now, the good thing about appreciated assets is they can be carried over for 5 more years. So a donation today, if you can't use it all up against 30% of your adjusted gross income, you have 5 more years to do so. The problem we have here is today's higher standards of deductions, standard deductions, are pretty high. And again, most people, when they contribute money in smaller amounts to charities, there's probably not enough money in there to exceed the standard deduction. So most people simply just take the standard deduction, which for 2025, as you can see on the sheet here, is $15,750 for single tax filers, $31,500 per joint, and those older, it's heavy here, $33,200. So the problem we have here is that with a very high standard deduction, a lot of people, even though they make charitable contributions, really can't deduct it because their standard deduction they get automatically is so much higher than if they itemize their deductions. Let's talk about a couple of things that are happening, though, that are going to make this a little easier. One, starting in 2025 with the big, beautiful bill or whatever they want to call it, there's something called the senior deduction. And what is the senior deduction? Basically, for this year, seniors age 65 or older can now pick up a $6,000 deduction for individuals, $12,000 for joint filers, even if you don't itemize. So that's a very important thing. Now, the problem with that is in all things that the government gives you, they have takeaways. And one of the takeaways is that if your income exceeds 75,000 as an individual or 150,000 as a joint filer, that those deductions diminish. And in fact, they disappear entirely for individuals with $175,000 of income and joint filers with $250,000 of income. So there is a new senior deduction that is pretty attractive, but it does, for higher income people, it doesn't mean much. As you know, the New York State property tax of what, $40,000 was wonderful, but then again, if you make too much money, you really just go back to the original 10,000. So there's always caveats. Good news for next year, though, in 2026, there's going to be a standard charitable deduction, whether you itemize or not. And as for singles, it's $1,000 for cash donations, and for joint, it's $2,000 for joint or for cash donations. So that's going to be attractive for next year. So even if you take the standard deduction, you'll still be able to deduct an additional $1,000 or $2,000 based on your filing status. Now, all this good news comes with some bad news that for those who itemize, the deductions that people make to charitable contributions have to exceed 0.5% of their adjusted gross income. Now, what does that mean? That means if someone's has a family of $200,000 of income, 0.5% of that is $1,000. So the first $1,000 they donate is not deductible because of this 0.5% contribution base against adjusted gross income. So that's one little negative impact that's in the new tax bill. So let's see what else we have here. One of the things you're going to find, making charitable contributions really helps you in a lot of different ways on taxes. So what we want to talk about here is the charitable estate gift to, say, New York State estate taxes. Now, we know in 2025, the federal estate tax exemption is almost $14 million. And we know the next year it's going to $15 million. So times two, if you're married, that's $30 million next year. Probably not going to pay, for most people, federal estate taxes. But New York State's different. New York State's exemption is only $7,160,000. So it's pretty high, but it's called the cliff exemption. So what happens here, and this is different than the federal tax, is that New York State has that 5% cliff provision, which means 5% times $7,160,000 is $7,518,000. Which means when you pay estate taxes, the first 7.1 million of taxes of a state is not taxed. The difference on the next 5%, though, between 7.1 and 7.5 is taxed at just the difference on those numbers. And what happens, though, is once you exceed, even by $1, the $7,518,000 cap, then you go back and pay taxes on the first dollar in the estate. So it's a cliff. It's a cliff you really don't want to go over. So you'll see in the bottom here that a $7,518,000 estate would incur roughly a $11,000 New York State estate tax. It's $10,954. However, $1 more puts you over the cliff, and you go back and you pay taxes on the first dollar in the estate all the way up to the 7.5 number, and that creates a $706,000 New York State tax. Okay, so there's a big difference of that one extra dollar. So how do you plan against that, just in case you're in that area where it may happen? And it says good estate planning is called a Santa Claus provision in your will that allows your executor to basically gift money to a charity to get you off the cliff. So even if you had to donate $100,000, you could save over $700,000 in taxes. So we think that the New York State cliff tax is something should be considered, especially when you're writing wills and making sure that you have that provision to authorize that charitable contributions can be made. Okay, let's go to our first one, beneficiary designation gifts. This is basically where, as Sean said, people who have beneficiaries, and again, beneficiaries are going to take place on a life insurance policy, on your IRA account, or if you have an investment account that's just a personal account that doesn't really have a beneficiary, you can have what's called a transfer on death title. So have whoever manages your personal money, have them put a transfer on death designation in the title, so that immediately upon your death, the money will then go to the beneficiaries you choose, which does save probate and all sorts of different costs and time delays. So you can see that designating very simply a beneficiary designation is something you really want to do. It's so easy to do. The other thing is you don't have to do the entire amount. Simply add a dollar amount or better yet, a percentage. And who wouldn't want to get 15 to 20% for good service, right? So on your personal brokerage, bank, investment accounts, consider adding a transfer on death authorization and adding a beneficiary just like it exists in your IRA, 401k, or life insurance. Next one we have is called the charitable gift annuity. This is where you actually make money. And Sean, would you like to talk a little bit about the charitable gift annuity, which is basically putting money into an exchange for a promise to pay you a fixed amount of money for the rest of your lives? And again, the good thing about these incomes that you buy with a gift annuity, they can be immediate or they can be deferred a few years. But the bottom line is you're supporting a charity because they are the one that will receive the money upon your demise. Sean, do you have any follow-up on that?
No, the other thing I think about these is compared to many other gift types, these are just a simple written contract between you and Stony Brook. The rates are set by a national organization. They're fixed at the time of the gift. You get them for the rest of your life. You get a deduction. If you give appreciated assets, part of the capital gain is forgiven at the time of the gift, and the rest is stretched out over what the IRS has determined as your life expectancy. They're really quick, simple, efficient ways to, I know a number of people who have, especially in times like this, replaced the fixed income portion of their portfolio, or at least a part of it, with a gift like this, since that was oftentimes they feel like it's underperforming. So if there are assets there, we can send you an illustration. There's, I'll say at the end, but there's literally no obligation. We're happy to put these out. They're quick, they're easy for us, and we can have a conversation about them.
Yeah, it's a real win-win situation because you get a deduction and part of the income is tax-free. And again, you're doing good by when you no longer need the money will go to the charity of choice. So let's talk about donor advisor or donor advised funds. These are extremely popular today. Basically, it's a personalized account that you set up and you donate generally cash or appreciated securities to it. What's interesting about it, the money goes in, you get a full tax deduction for it, and then you get to make contributions or distributions from that account to your favorite charities at the time of your choosing. So if you put in $5,000 now, you can send $1,000 out this year, $1,000 next year, maybe $2,000 the following year, nothing the fourth year. It's entirely up to your time. What's interesting about it is because you're basically, because of the limitation, if you itemize on your tax return, you may not have enough money to exceed that standard deduction. So these donor advisor funds basically allow you to bundle up future contributions in the current tax year. And you get the deduction this year. And that's very important for someone maybe who's retiring, who has a big income this year and will have very little income next year. So the fact that the deductions or the contributions they make to charities in years 2, 3, and 4 are going to be less because their tax bracket will be diminished. So let's get the tax deduction all in the higher tax years. So it makes a lot of sense. We love the donor advisor or advised funds. I have one, and every time I decide I want to make a contribution, I simply go on the computer and send them X amount of money. And it's so easy to do. But remember, the deduction is taken at the year of the gift. However, the distributions are done at your leisure. Next, one of my favorite tax favorite things is a qualified charitable distribution. Now, qualified charitable distribution is basically allowing people who are age 70 and a half or older to contribute directly from their IRA accounts to a charity of their choice. It has to be a qualified charity, and the maximum amount they can do this year is $108,000 to a charity at age 70 and a half or later, or married $216,000. Now, why would you do it? Because basically it satisfies your required minimum distribution for those who turn 73 or 74. They have to take distributions. This will satisfy their distribution for the, or partially distribution up to the amount of their R&D. The good thing about it is it's not reported as income, nor does it have to be deducted on your tax return. It's automatically done and shown on your 1099-R when you receive your tax return. What's interesting, though, is you have to make sure if you're going to do a qualified charitable distribution, you have to do that before you take any R&D. So if you haven't taken your required minimum distribution, you are old enough where you have to do that.
Now is a good time to simply call up the sponsor or whoever manages the funds and say you want to do a qualified charitable distribution to hopefully the Stony Brook Foundation. Tell them how much, and they will then send the check directly to them, or they'll send the check to you made out to them, and then you can bring the check here and shake hands with everybody as you give them your contribution. The good thing is, as I said, it reduces your R&D. Now, why is that? Why is reducing your R&D important? Because it reduces your tax liability. And as I said, there's a lot of ways, there's a lot of things that look at your income to determine how much you're going to pay. And we talk about what's called IRMA here. Now, IRMA is a nice phrase the government put together called the Income Related Monthly Adjustment Amount, IRMA. And basically, the amount of income you have is going to determine how much monthly Medicare premiums you pay for Medicare B and D. Now, for 2025, for example, IRMA, there's 4 or 5 different income levels, but at the $266,000 level for a joint return, they charge you $273 a month for both B and D premiums, which is deducted off your Social Security before you get it, of course. Now, what's interesting, though, if you look at the IRMA, if you have just $1 more, $266,001, this is like another cliff. The income jumps to $405. So for a couple, that cliff increase is $3,168 because you had $1 more of income. So that's why you want to make sure that what's a good way to reduce your income as well, reduce the R&D. So if your R&D is $40,000 and you make a qualified charitable distribution of $10,000, your taxable income is going to go to $30,000, and there's nothing you have to do to report it; it'll be automatic. So there's nothing that has to be done. Extremely efficient to do that. Let's talk about trusts. I love trusts. Trusts are pretty easy to put together. You do need a lawyer to do that for you. And a charitable, there are several different types of trusts. The first one is called a charitable lead trust, which is basically a trust that pays money to the charity for typically a number of years, maybe 5 or 7 years. And after that point in time, the money goes back to your family. So it's a very temporary transfer of annual income to the charity of your choice, and then you recover the money at the end. The second one is called, we'll talk about it, is the charitable remainder trust, and that's basically that pays you the income, typically for a number of years or up to 2 lifetimes, which is very attractive. And then when you're both, if you took the 2 lifetimes and when you became deceased, the second person died, then the money goes to the charity. So the lead trust, the charity gets the money first. You get it after the time expires. The remainder trust is you get the money first, and upon the time period, it goes to the charity of choosing. And there's 2 types. There's an annuity and unit trust. The annuity basically simply pays a fixed dollar amount. So when you see the word charitable annuity, that means it's going to be a fixed dollar amount, as opposed to a charitable unit trust. Lead trust, then that's a fixed percentage. So it's either a fixed dollar or a fixed percentage of the assets that are in there. Now, why do people use percentages? Well, for charitable lead trust, they always use, in my experience, fixed dollars. They like to know that I'm going to get X amount of money for 5 years or 10 years. On remainder trust, it's a little bit different. The percentages seem to be more popular because what happens is if you're doing a 6% trust, on $1 million, that's $60,000 a year you receive as income. But at the end of the year, you look at what the account balance is on January 1st. And if you made 8% on the account and you were paid out 6%, it's going to be 2% higher. And now your income for the next year is going to be 2% higher than it was when you first started out. So we like using percentages or unit trusts. So you have that. Also, there are 2 types of trusts that fall within the lead trust. There's a grantor trust and a non-grantor trust. And basically, the donors have an option of either, do you want the tax deduction up front? That's what a grantor trust does. They get a deduction and they put the money in up front, but they do pay the tax on the trust income as it's paid out to the charity, believe it or not. The alternative to that is a non-grantor trust where the donor gets only a deduction on the income that's paid out and no deduction up front. Now, again, what works best when we do our planning is basically people that are retiring with large incomes this year will want the deduction up front. And then as they retire, their income goes, their tax bracket declines. They'll want to pay the income tax on the income going to the charity, and a much lower bracket makes more sense. And we'll show you that in a minute. The other thing, if people do Roth conversions, which are very popular now, people love to convert taxable IRAs to Roth IRAs. That creates a big tax when you do that. Again, having a grantor trust set up where you get the important big tax deduction up front will help mitigate the tax liability on doing a Roth conversion if you're thinking of doing that. Let's take a look here at an example annuity lead trust. And this is a grantor trust. This is one where you get the deduction up front. So you'll see how it works. The example here is Tom Donor here has stock that he bought. Maybe he bought NVIDIA or Apple or Amazon for $750,000. It's now worth $2 million. It represents a nice part of his portfolio, but not by any means all of it. So his capital gains is $1,250,000. So he wants to do is going to donate the $2 million of stock to the lead trust, and then have the lead trust for, in this case, for 5 years, pay an income at a 7% fixed dollar amount to its charity. So the charity's going to get $140,000 a year for 5 years. And after the 5-year period, then the assets are transferred back to the donor or to his family. And you'll see on the right, the trust will receive the trust to the donor is going to be $2,117,000. And that's based upon that in our projections, we assume that we're going to earn 8% on an investment over 5 years. So paying out 7 on a fixed amount, we're going to have a 1% appreciation in the trust. So the $2 million becomes $2,117,000. Pretty basic. So you'll see here in the bottom, it gets a little more detailed. It says here, by doing that, the gift asset to the lead trust, you receive an income tax savings of $214,000. That's a pretty nice incentive to do this. The potential capital gain reported by the grantor. Okay. Number 2 is this: the 7% for the charity gets $140,000 a year for 5 years. That's a gift of $700,000. Now that's terrific. If you have signed a pledge to give money for, say, 5 years, this helps you fulfill the pledge. Very, very simple to do. And you'll see at the very end, at the term of the years, the trust assets simply are returned back to the donor or to his family. Now, this shows you how we calculate the tax deduction. Again, we work with your accountant to do this, but you'll see that the deduction is $614,000 under row E. And again, assuming the individual's tax bracket, according to the accountant, is 34.9%, federal and state, that's a $214,000 tax savings. Okay. So let's take a look at, as we said, the negative to this is that out of the $214,000, we're going to have to pay tax on the money that goes to the charity. So you'll see here the payment to the charity of $140,000 for the 5 years. There's a tax that has to be paid of $32,493. So you see what the total tax adds up over 5 years is to $162,000. If you subtract that from the $214,000, there's still a net benefit of tax savings of $88,000 on the lower far right. Does everybody see that? So it still makes sense to do a lead trust, even though you get taxed on some of the income that goes out if you take the tax advantage up front. Okay. Now, my favorite thing is the share remainder unit trust, which is similar, except remember, this is the one that pays you for a period of time or up to 2 lifetimes. And then upon the expiration of the time or the second lifetime, it reverts to the charity. Now, why would you want to do this? Well, again, appreciated assets to the trust, similar to my example here of a $2 million share of stocks with the cost basis, $750. We'll see how this works. But the donors get immediate tax deduction. When they set this up, the tax savings are generally sufficient. And this is interesting because what is the negative of this? The negative is very simple. Upon the second death, if we're doing this for income for 2 lifetimes, upon the second death, the money in the trust goes to their charity. Now, that's good for us, but it's not good for your children. The children say, wait a minute, what happened to that? What happened to that $2 million? Well, there's enough tax savings here, and you'll see this, that allow the donor to buy life insurance on the second life or on both joint lives to replace the asset. So when the asset goes to the charity, the life insurance goes to the family. So properly planned, it's a very significant tax savings. We call this the grand slam of tax planning because it gives all three. It gives capital gains, ordinary income, and estate tax savings. And we'll show you how that works right now. So one other thing is there's something called the charitable legacy rider, which we mentioned. Some insurance companies, not many, this one, Equitable, has one that basically says when you take out a life insurance policy from them, they will donate 1% of the face amount to a charity of your choice, in addition to paying the life insurance benefit. So a $2 million death benefit, in this example, is going to give an additional $20,000 to a charity of your choice. Okay. So let's take a look at this. This is called a unit trust with the insurance trust. The insurance trust is simply there to replace the asset because Tom and Mary said we wanted to set this up. We love our foundation, but we want to make sure our children also get some money out of this as well. So this is how it works. Again, on the upper left, the property of $2 million goes in. Underneath it, you see we bypass all capital gains, which is $1,250,000, and we get a tax deduction. Those are pretty significant tax advantages. And you'll see that for 2 lives in this case, they're going to have an income of 7%. Now, this is a percentage, not a dollar amount percentage. So they have starting with $140,000 of income for as long as either of them are alive. Okay. And from that extra income, because remember, they're drawing the income from $2 million, not after capital gains are paid. This is before any capital gains, because there's no capital gains paid here. It's all bypassed. So you'll see that with this increased income, there's enough to give to an insurance company, in this case is $20,000 to buy a $2 million life insurance policy. So on the far right, when both lives are over, the charity gets, in this case, 2.6 million, and the family gets 2 million. So let's take a look at this details it a little more so you can see how it works out. The deduction is $328,000 on the left, saving taxes of $114,000. Bypassing the capital gains also saves another $386,000. So this is a $500,000 tax savings by setting this up in the year they set it up. And you'll see the unit trust pays 7% to the donors for 2 lives. The first year income is $140,000. And again, in this example, I'm assuming that we can earn 8% on the unit trust asset. So the amount of money is going to grow every year because of 7%. At the end of the year, with a 1% growth in the fund that hasn't been paid, it's going to be more income. And they paid $20,000 in insurance premiums for the 31 years, which is their life expectancy, by the way. So these people are age 62, and Mary is 60. So Tom's 62 and Mary's 60. It's ideal for them because they're looking for retirement income. By the way, the more income sources you have, the better it is. And everybody who generally retires is going to have, they used to have a pension and Social Security, which is everyone gets. And then, of course, they have required minimum distributions from their own retirement accounts, and they have their own assets. But again, this is another income they're going to have at $140,000 a year in addition to Social Security, pension, and RMTs. It's pretty attractive. So their life expectancy is 34 years. And less the premium, they're going to get $4.9 million, which is a return of 7.43 because of the tax savings. Pretty attractive. And let me just show you this page here. This basically shows an example that compares selling the asset outright and paying the capital gains and then living off the proceeds and then passing the assets to your children, as opposed to simply doing a charitable remainder trust. And what we want to do is compare apples to apples. We assume that if they did the charitable remainder trust, what if they lived off the same exact income they would have gotten had they just sold the asset, which isn't the most tax efficient way, but let's assume they lived off the same assets, same income of $86,000 for the rest of their lives. And they banked the extra money and the tax savings they're getting, put it in a side fund, and they earned 8% on it over their lifetime. You'll see here on the second, not on the far right, it shows there's like $625,000 of extra money that's going to be sitting there in year 34 from this extra money that the charitable remainder trust created because of the extra income. So if you live off the same exact amount of money and bank the difference and invest it, you're going to have in year 34 $625,000, but also in year 35 $699,000. Again, we're expecting they're going to die somewhere in between those 2 years. So if you take a look at this is an extremely important page. In the middle, it shows the sale of the assets of $2 million, less the cost basis of $750, capital gains of $1,250,000. Assuming the capital gain rate is roughly 30%, the capital gains tax is $386,000, which leaves $1.6 million left over. It's that $1.6 million that they live off of that generates the $86,000 of income. And notice under Roman numeral 5 in the bottom, under total benefits, when they die 34 years later, having just lived off the income, again, $86,000, that 1.6, again, we're assuming they live in New York State. So there's going to be an estate tax because these are relatively successful people. They're going to be over that $7 million figure. But I only assumed a 10% tax on the state. Now, New York State, the tax marginal rate is 16. But let's assume it's only 10. They're not the high net worth individuals in their neighborhood. So, but again, with $1.6 million and a 10% estate tax, hypothetically showing here, they're going to pay $161,000, which is going to net their children the difference of 1.4. So if you see down there, total to the family, 1.4. So that's nice. They had the asset, they sold it, they lived off it for the rest of their lives, and the children got the net proceeds less a small estate tax, netting that 1.4 million. On the right side, it shows, if we get down to Roman numeral 5, it shows that the amount of assets they accumulated by living off the same exact amount of money was a $684,000. That was the sheet we just looked at. $684,000. Now we assume that's in their estate because they just put it in the bank. The 10% tax on that is $68,000. That means they got $616,000 from that side fund, the kids. Plus, don't forget, this includes buying the life insurance for $20,000 a year. So the life insurance is $2 million tax free. So what does the family get? They get the $616,000 from the side fund, and the life insurance gives them the $2 million, which is estate tax free because it's outside of their estate. That's the estate tax savings. So the children get, instead of 1.4, they get 2.6. Who wouldn't do that? The nice thing about it, underneath it is, hey, wait a minute, that's not the end of the story, because now the charity gets money too, and they get 2.6 as well, in addition to the 20,000 that they would receive from that rider that the insurance company is giving that extra 1% to a charity of their choice. So the issue here is, if you simply sell the asset and live off it, you have a nice income for the rest of your life, it's $86,000 a year, and the kids get 1.4, as opposed to living off the same 16,000 and the kids get 2.6. And icing on the cake, in my mind, 2.6 goes to the Stony Brook Foundation.
David, quick question that what are the average assets for people that do this kind of gift? I know, like at Stony Brook, our minimum for a CRT is simply 100,000, and that's, more of a charitable gift and less of a tax planning strategy. But so tell us a little bit about the type of people that are interested in these gifts mostly, and their sort of asset bases, or where you see a lot of your clients that do these coming from.
Yeah, the ideal person for a charitable remainder trust is someone in their 60s, looking for what? Retirement income. And this is not retirement income that they're getting. And again, Uncle Sam is basically giving them enough money to buy life insurance to also replace the asset when the money goes to a charity. So it's a win-win-win situation. The other thing is that when you compare this, say, to a pension plan, now this 140,000 they're getting here, basically, here's how charitable remainder trusts are taxed. They're taxed under a 4-tier system. It's from worst to best. So when the trust creates ordinary income in the investment, so we manage these trusts a lot. We do the investments. We have very little ordinary income in there. That is passed through first. So if a trust has $10,000 of ordinary income, interest or dividend income, short-term dividend, that has to be taxed first. And the difference would be then capital gains, long-term capital gains, which is taxed at a much lower rate. And then it gets down to where if we had municipal bonds in the portfolio, that would be the third income, that's tax-free income. And then the fourth would be any return of principal that was in there. So it goes from ordinary to capital gains to tax-free to principal. Now, again, when you compare that to a pension plan, so if this person has a $140,000 pension plan, first of all, when he goes to elect his pension, they're always going to ask you, is your wife going to be part of this? or your husband part of this? And you say, well, yes, well, we're not going to give you 140 because now it's for 2 lifetimes. You know how that all works. So we're going to give you $130,000 because it's 2 lifetimes. Well, here there's no reduction. 140,000 stays the same whether it's 1 lifetime or 2 lifetimes. It makes no difference. But what's important here is the income is largely capital gains, not ordinary income. So when you have a pension plan, you're going to pay ordinary income. Here it's going to be largely capital gains. So having 140,000 at a capital gain rate is much more attractive than an ordinary income. So we think this is again the grand slam of tax planning, that it gives all capital gains, ordinary, and of course estate tax savings, and again gives you more income, and again more to your family. And it's nice because we're really letting Uncle Sam provide the incentive to basically protect your family through the life insurance, as well as other, giving you actually more income here. So this is simply more than how we do the tax deduction. And again, what's interesting to know here is under section B, again, these are people 62 and 60. And again, this is a $2 million gift amount with a cost basis of $750. And we're going to pay them quarterly. So out of the $140,000, they've asked to say, why don't we give you a quarterly check, which we set this all up to do it that way. And again, we're assuming that they want to take out 7% of the trust. That's flexible. It has to be at least 5% of the account. But again, in this case, they're asking for 7%, and I'll explain why we do that. And underneath that section B is there's an AFR that's declared each month. The current rate is 5.2%. The higher the rate, the bigger the tax deduction. The lower the AFR rate for the month, the lower the tax deduction, but you get to pick the current rate or the 2 prior months. And again, this is part of our planning to go see what those rates are. It gives you the highest rate for doing a charitable remainder trust. For elite trust, you want this to reverse. But you can see here that it comes down where the $328,660 under line M is what is considered to be the amount of money the charity is going to get in 34 years. They're not getting it now, but that's how much you can deduct in 2025. And again, if you're in a 34% tax bracket, that's $114,000 of savings plus the capital gains. So this is what we give to your account to look at. So that's basically the reasons we love charitable remainder trust. It's an income device for the family. And it also gives your children, if it's done properly, and it doesn't work every time. As you said, Sean, we like the 60-year-olds. The amount of, the more appreciation we have, the bigger the capital gain savings are, of course. But generally, in today's environment with the baby boomers, which I'm part of, the baby boomers obviously have been lucky to have some very strong market returns for the last 3 out of 4 years. So there's a lot of appreciation. And you know, some of the high flyers obviously have doubled in the last 6 years. So I mean, we do see a lot of appreciation, which is good for charitable remainder trust. It's bad if you simply want to try to sell it and live off the proceeds after you pay the capital gains tax. So appreciate everyone for taking the time today, and we'll answer any questions you have. But again, we put up here the people that you should be calling if you have any questions about this. But we'll answer questions now, Sean.
Yeah, so we had a couple questions around fees, and I know oftentimes it depends, but do you have a sense of what the legal or even accounting fees are surrounding the various trusts to set them up? I know, from our experience, I know that there's boilerplate CRT letter like trust language, but in the more specialized you get, the more expensive it gets. But typically, in my experience, those aren't relative to the value of the trust, not that expensive. But in your experience, what are the costs to set those up? Are they extravagant? What are your sense? And I know
Well, we're not lawyers. We don't do the trust, and generally the family attorney will do it, or we have people that we know that do specialize in these type of things, and we've asked them to be gracious if we're working with charities that we try to promote to give a sort of a discount off their normal fees to do it. But again, if you have your attorney, you're happy to do it, that's fine. But you're right, Sean, the IRS actually came out with a standardized trust agreement. You just fill in the blanks. So it is something that isn't too complicated to figure out what percentage you want and what kind of assets you're using to do it. But I've seen people charge $1,000, $1,500 for a trust. But again, remember the tax savings we're getting here. So the question is, what size makes the most efficient gift to a trust? And again, it's probably going to be in the $100,000 range, I would think. To make the cost of setting it up. Now, the insurance trust doesn't have to be a typical trust. It can be simply letting the kids own the policy. So you don't need a second trust. As the presentation showed, it was two trusts. There was a remainder trust and then an insurance trust. The insurance trust, obviously, if you have two kids that are mature, just let them own the policy. You don't have to have an extra trust for that.
And the scale of a CRT versus a CLT, the lead trust. I know the lead trust, typically those are larger. Is that been your experience? And what sort of assets are best to put inside those?
Well, again, appreciated assets are the thing to do. They can also be done on real estate things, those type of items. But generally, it's much simpler if somebody looks at their portfolio and they pick out 3 or 4 stocks that are the most highly appreciated and use those to get that. And that will determine how much they're going to provide as a lead income based on the total assets that they have that are highly appreciated. It might be only 100,000. It might be 50,000. It might be 250,000. It might be $1 million. The last person we did, they actually had won, and they won a lottery. We invested money, and this is their scenario of 750,000. We invested, and it grew to 2 million, and we put it into a charitable remainder trust. And now they're taking out 8%, not 7, 2 million. So they started with $160,000 a year, which is terrible. And right now the account is now about $2.5 million. It's grown so much more, and now every year they take out 8% of a much higher dollar amount. So they're very happy with it. And the reason we had to go to 8% is because their incomes weren't high enough to use up all of the tax deduction. As I said, the tax deduction on appreciated assets is 30% of adjusted gross income, 30%. So someone making $100,000, you can only deduct $30,000 a year off of that. But remember, you can do it for up to 6 years. So we had to make sure we raised the contribution to them high enough, which when you do that, it reduces the deduction. The more you take out, the less the charity gets. So we went from 6 to 7, then ended up at 8%, and that dropped the deduction down to where it was usable over their 6 years based on their adjusted gross incomes.
Great. Someone asked, and then this one I can answer actually, the cost to set up a gift annuity or donor advised fund with Stony Brook Foundation. So there is no cost to set up a gift annuity with Stony Brook. It's simple. We absorb a lot of the cost. There's, investment fees every year. It's sort of baked into it, but there's no cost to set one up. It's just a simple written agreement. Stony Brook does not offer donor advised funds, but all your largest financial institutions do. If, for instance, like we're Stony Brook employees, we work with TIA. CREF, they have them. Fidelity has them. Vanguard has them. And the fees typically are fairly reasonable. I don't know, David, if you have one with Black Oak, but
I do, but remember, you're donating X amount of money, and then that money is a donor advised fund is money that is gone. It's not your money anymore. You get the tax deduction up front and the capital gain savings, and then you just dictate the money going to the charity. So I use Fidelity personally. They're excellent at it. They were rated #1, and I just call them every now and then and said, send $1,000 here, send $1,000 there, and it's done. It's really easy to do. But as far as the fees go, I don't really care what it is. I'm more concerned what they give me a choice is how I can invest the money, because not only did I get a tax deduction when I put it in, but I got tax savings as the money stays in and grows. By the way, if you make a DAF investment and you don't make any distributions for a while, the money just grows tax-free. And then, of course, you get to dictate how it goes out, and you can use 2, 3, or 4 different organizations that send the money to. It's a wonderful vehicle. But as far as the fees go, it really doesn't make any difference because that money has been donated, so it's gone.
Sure.
But I can assure you, they don't.
And one of the things I've heard and I've seen now with the big beautiful bill being passed is that donor advised funds may be more of a storage area as people trying to exceed both the floor and now the standard deduction. So they're going to what we in the industry call bunching. So instead of making the same gift every year, you put 2 years worth of gifts in one. You can put it in a donor advised fund and then spread it out over the next 2 years. So there may be an increase in those. So that's a great question. If you want more information, either reach out to David or myself, and we can help you with what your ultimate goals are. There's also a question that came in, and this is one that I guess I'll take. where you can get information on donation to specific scholarships to students or research at different departments. Just reach out to me or my colleagues, and we'll be happy to help you with that. Unless you're working with someone else, like at Stony Brook, but feel free to reach out to us, and we can help lead you in the right direction. That's easy enough to do. Um, Great. Anything else, David, before I sort of wrap us up, or?
No, just thank you on who are listening to this for giving your time, and we greatly appreciate it. And we hope to have helped you create a more tax efficient way to transition your wealth. Thank you so much.
Great. Well, David, thank you so much for sharing your wisdom with us this morning and your slides and your information. It's always great and thought-provoking, especially this conversation, like specifically around philanthropy and financial planning. I hope what everyone takes away is charitable planning isn't just about giving, it's about partnership. It's about creating legacies that provide value for you and your family while advancing the mission at the institutions you hold dear. We hope that's Stony Brook, but if it's not, we understand, and that's why we're doing this because we realize that Stony Brook's just one of many charities that many people support. But if we can help you give wisely to them and perhaps have a little bit more money in the bank, then you can be more philanthropic. As I said, we're entering an exciting era under President Goldsmith, and every gift will play a role in propelling us forward. It's really remarkable, even in the 3+ years that I've been here, how much Stony Brook has advanced and changed and grown. So my colleagues and I, as I've said repeatedly, would be honored to continue the conversation with you. No questions too small, no conversation too early, and of course, there's never any pressure or obligation. Our goal is simply to be a resource, and whether you choose to make the gift or not, this is part of what we do, and educating people is part of what we do. So we're happy to do it anytime we need to. Thank you again to everyone for being with us today and for your commitment to Stony Brook. I see a lot of good friends of Stony Brook on the list, so we appreciate you joining us, and hopefully we can all work together, us, David, you, to ensure your legacy and our mission here. All right. Thanks, everyone. We appreciate your time.